1031 exchange. Well, what is it and how does that work? Now, when it comes to real estate, I love using 1031 exchanges. 1031 exchange, I'll really boil it down really quickly. You're exchanging something that you own, selling it, and then buying something else that's worth more than the original thing that you bought. You're exchanging what you own into buying something that is worth more. Now, hey guys, my name is Dustin Heiner with Master Passive Income. I am so glad you're here. I want to show you how to invest in real estate rental properties so you never have to work a job again. Now, I want to share with you how 1031 exchange, how they work, how they can apply to you, and how you can almost get trapped if you do not do things the right way. Now, with a 1031 exchange, it is fantastic to be able to buy a property, have it as an investment property, make money every single month in passive income, which is what we talk about with rental properties, then sell it and not have to pay taxes, put that into a better property. Let's give you a broad example. Let's say you have a 3-bedroom, 2-bath house. That's 1,200 square feet. You're making $250 in passive income every single month from the rents on the property. You want to sell this house. You never lived on it. It's not your personal residence. It's not where you're currently living. It's an investment property. So you're going to sell this property and then buy a bigger and better investment. Let's say it's a 3,000 square foot house that has 800 bedrooms, or I'm just being way over facetious, but you're buying a house that's like maybe 4-bedroom, 3,000 square feet, and it's a really nice, much better house. You're going to make maybe $300 or $350 in passive income. You're going to sell this one house, and then you're going to use that money tax-free to buy the next property. Think of it like Monopoly. If you've ever played the game Monopoly, you buy the land first. You go around the board, you land on one of the square, Park Avenue. Okay, you buy the land. That's going to cost money. Then you go in and you build houses. You save up money, build a house. Then you go from there, you add more houses, and then you tear them all down, and then you put a hotel there. You're constantly upgrading every single time. Same thing with 1031 exchange. You're upgrading everything that you have to something bigger and better, and not paying taxes. That's the biggest thing, the best thing. The reason why we have 1031 exchange is because we are able to exchange something we own for something better and not pay taxes on it. Now, let me walk through everything you need to know about 1031 exchange. Now, a 1031 exchange is bigger than what I'm going to tell you now, so I'm not an accountant, so don't take my word as an accountant. Talk to your accountant. They'll take care of you. But these are the broad overviews that you really need to have when you're doing a 1031 exchange. So number one, it needs to be like kind. Like you can't, let's say, buy a property, sell it, and then buy a horse. Like that's not like kind. It's like kind, like real estate for real estate. Now, I have heard of some exceptions where you can do that, but I'm definitely not an accountant. Don't talk to me about that. Talk to an accountant. But if it's real estate for real estate, you can absolutely trade that or sell it, turn that money into a property that's bigger and better. Let's say you have a single family home, but you're realizing, you know what? I can buy an apartment complex that I can have passive income, more doors and more properties. You can absolutely sell that and transfer that into an apartment complex or a commercial place. Anything in real estate, you can absolutely, it has to be like kind. That's what the IRS rules are. It basically has to be like kind investment. Now, another thing, it has to be an investment. It can't be your personal property when it comes to real estate. It can't be your personal home. Now, a great thing though, don't think of that as negative. The great thing about having your own personal residence, if you're selling your personal residence, you literally don't get taxed. That's not a taxable property that you own. See, now there's income tax and there's also capital gains tax. If you buy an investment property and you sell it, you're considered getting, if it appreciates in value, you get capital gains. You gained money from that property that you bought. With your home, the great news is you're not getting capital gains. You're not going to get taxed. That's literally money in your pocket. They will not tax that. So it has to be an investment property. Obviously, the good thing is you don't get taxed the other way. The second way, you can get protected with a 1031 exchange. You have an investment property, 3-bedroom, 2-bath. You want to move up to a 4-bedroom, 3-bath. Sell this one. Turn it over into another property that's bigger and better, and you're going to have without any taxes coming out of your pocket. It's fantastic. And another thing that you got to worry about or just know about, it has to be the same taxpayer. Like you can't have it from you to your brother or your uncle, it has to be the same person, same taxpayer. Now, if you're married, that's obviously the same. It's you're together. That's how the IRS sees you. Now, it has to be the same one. So that's another thing you got to make sure. You can't just give it to your brother and then boom, boom, boom. It has to be the person who owned it, sells it, puts that money into an account that is governed by a third party. You literally cannot touch it, and then you use that to buy the next property. Another criteria is the value has to be equal or greater than what you currently own. Let's say you're selling a $100,000 property. You bought it for, let's say, $60,000. It's appreciated or you fix it up. It's now worth $100,000. Well, that is a $40,000 gain. That's capital gains. But you sell it, now you have to buy a property that is worth $100,001. So it's worth just equal or a little bit more. So either $100,000 or $100,001. That is the criteria. If it's lesser in value, it doesn't fit that criteria. It has to be equal or more in value. Now, another part of the criteria is you need to identify a property within 45 days of the sale of the property. You can't wait any longer. You need to actually have it identified. You can't just say, indefinitely, I'm just going to keep that money over there. I'm indefinitely going to keep it there so I don't have to pay taxes. No. You have to identify and say, I'm buying this property. This is the address. This is X, Y, and Z. You have to have that in the criteria. So 45 days to identify a property. Now, in actually closing, in finishing out the entire 1031 exchange, you have 180 days, basically half a year to actually close on the property. So 45 days to actually identify the property, but then 180 days total from the sale of the property to then closing on the property. 180 days total to actually close out, and you now own that new property. Now, there are ways to do partial exchanges. So the value is not 100% or more of the current value of the home that you're selling, but it won't be completely tax-free. You can do some tax-free. Again, talk to your accountant. There is a way to actually do a partial exchange, but it's not completely tax-free like the 1031 exchange. Now, let me give you a practical example of how a 1031 exchange will work or will not work. So let's say you buy a house for $150,000. It appreciates to $250,000. You sell it and you want to do a 1031 exchange. Now, the increase that you've made is $100,000. Remember, $150,000 to $250,000. That's $100,000 in an increase. Now, it's not trying to get a price above $100,000 because that's how much you made. No, it's the total dollar amount that you sold the property for. So if you buy a property that's $250,000 or $250,001 or more, it's a good 1031 exchange. If it's below that, like you can't think it's the equity that I have, that's what I have to get over. No, it's the total dollar amount for that property. Now, a 1031 exchange is not very, very complicated. It's actually very simple. And if you talk to any title company, if you talk to any accountant, they're absolutely going to know how to handle a 1031 exchange. Now, here's a great thing about real estate investing. You're not the expert, and I'm not the expert in real estate investing in our areas, in our niches, in the banking, in the accounting, or anything like that. We hire experts, and our business pays for everything that we hire from them. So this is what I want you to do. Call up a title company and call up an accountant. Call them up and talk to them. Say, I'm doing a 1031 exchange. How would I do it? Obviously, you're going to have to pay them for their time. They're not just going to give you free time, but you want to talk to them because as you're doing that, you're going to get so much great information. And who knows, you may even use them. And hopefully you will because you're utilizing their time. You use them to actually do the 1031 exchange, and you're going to be successful in deferring your taxes off because you're not skipping out on taxes. You're deferring your taxes. So guys, that's how we could do 1031 exchange and all the things about it. Check out this video right here. I want to get you investing in real estate. All right, guys, we'll see you.